Hello, everyone. This is Zak Gardezy. I'm the host of Money Minutes. I'm also the founder of Wealthstone Private Wealth Management. So, here on Money Minutes, I'd like to share with you some of the latest market headlines and my outlook for what's ahead. So, for this week's episode, we're going to cover the latest economic reports that are showing the economy is slowing down significantly. And also, I'll cover some of the latest market updates, specifically around some questions that I'm getting around what are small cap stocks and mid cap stocks, and what's going on in relation to the rest of the market. And so let's get right into it. Okay, so let's get into some of this latest economic data. And so we'll start with the labor market. Non farm payrolls came in at a lower number than what was initially expected. But the interesting news is that the April and May numbers were again revised downwards. And so this has been happening a lot. Actually, over the last 12 months, 85% of the non farm payroll reports were revised downwards. But besides that point, this is showing us that the labor market is cooling. When we look at full-time employment is also down. And so this is the sixth time over the last 7 months of reports that full-time employment is lower. And so on one hand, we've got a clearly slowing labor market. And then you look at what's really been the big news, which is around the CPI report, which is the Consumer Price Index. So analysts were expecting the CPI report, or really broadly speaking, prices, to reflect actually a little bit higher for the month of June. But this was a shock to all. The CPI report actually showed deflation. So prices came down by 0.1% for the month of June. Now, this is a big deal because, again, it completely came as a surprise to analysts, but now we're dealing with deflation. And so, not to be confused with disinflation, which disinflation is really the slowing down of inflation, right? Prices aren't increasing as rapidly as they once were before. Deflation is something different. This is when prices actually come down. And this is a risk to the markets and to the economy because as prices come down, there's a couple reasons why prices would come down. You've either got supply, too much supply, so that will bring down prices, or you could have, a reduction in demand. And so why this turns into a slippery slope is because if you have a reduction in demand and that persists, right, you have continued deflation in the economy, eventually employers will have to lay off. And then you end up getting much higher unemployment. As unemployment goes higher and higher, that demand, of course, gets lower in the economy, right? There's people have less jobs, they don't have a job, so they can't spend as much. And then that turns into this trickling effect where you typically end up in a recession. So I'm not saying that this most recent report is showing us that we're, heading into a deflationary cycle and, eventually into a recession. But this was big news for the market. And really, it gave the rest of investors out there some confidence that the Fed will cut interest rates because, as remember, the Fed has really two broad-based mandates, which is price control and also stability in the labor market and, achieving maximum employment, basically. And so if you've got issues where, you're heading into a deflationary cycle and, prices are coming down, which could be affected, demand is coming down, right? Unemployment the labor market is clearly weakening. This is showing some serious cracks in the underlying economy to where the Fed will have to be concerned about, should we start to cut interest rates? Because as this economy is falling, right, slowing down significantly, are we going to be too late in cutting interest rates? And so the Fed definitely does not want that to happen because at least the trajectory that we've been heading down towards is a soft or softish landing. They could potentially miss time when they should cut interest rates, and we could end up in a situation where the Fed doesn't want us to be. And so that's the biggest news around the latest economic data. As I'll talk about in the next section, this is now trickling into the stock market where it's affecting things like large cap stocks, small and mid caps, and we'll get into a lot more detail about the dynamics that some of this latest data has brought to the overall stock market. Okay, so I'm getting a lot of questions about what's happening in the stock market. Over the last 7 days or so, a lot has really gone on. Specifically questions around, what are the differences between small and mid cap stocks and large cap stocks as well? And so it really helps to kind of break down, just around the different market caps and why do they have their specific names. So intuitively, small, mid, large has to deal with the sizes of these companies, but small cap companies are between the size of 300 million to 2 billion in market cap. Mid cap companies are between 2 billion and 10 billion, and large cap companies are the largest companies in the overall stock market. And really, over the last week or so, we've seen a pretty big shift after all this new economic data has shown us that, the small cap and mid caps have really picked it up. So far throughout the year, small caps, if you look at the Russell 2000 index, which represents the small cap market, this index was relatively flat for most of the year. And ever since July 9th and on, that index has just skyrocketed. It's up over 11% since then, and you're also seeing similar returns in the mid cap index as well. The large cap index has gone up, but it's been a more modest, rise compared to some of their other, competitors here. Now, this has to do with the fact that the economic data that's come out has been relatively appealing to investors looking to get into the small and mid caps and to diversify a bit from the large cap sector, which has done so well for much of this year. If you look at, for example, the S&P 500, which represents the 500 largest companies in America, it's heavily weighted towards technology and the mega cap sector. It's up about 20% so far for the year. And so the bulk of the return still has been in the large cap space, but we're now seeing the broadening out of returns throughout the market. Now, I'm still optimistic about the large cap space, but when you take this data and what's happening, what we're seeing with the small and mid caps, that's some pretty compelling information. Now, some key differences: small and mid-cap companies tend to do most of their business domestically because, of course, they're smaller. They don't have that global footprint that large-cap companies do. So there's pros and cons there, but the positive economic data, right, showing inflation coming down, the labor market cooling a little bit, but we're not heading towards a recession just yet. This has helped investors feel the confidence to shift into the small and mid-caps. But smaller companies do pose greater risk typically, and so it's not a type of play that I would recommend for everyone, but you're starting to see investors sort of flock to that part of the market. So hopefully that answers that question, and this really concludes this week's episode of Money Minutes. Thank you so much for tuning in, and I hope to see you all again next week. Thank you very much.